That's $1 million question. But in our view, the earnings momentum is absent and earnings continue to be muted. And if at all, the inflection point could be FI27. Until then, the markets will struggle in a sideways setup. In a way, we call it as a phase of time correction in which markets take a pause until the earnings catches up with valuation. At the peak in 2024 in October, India's weight in the MSCI EM index used to hover around 20% plus, and China's weight came all the way down from 30% plus to 24, narrowing the gap to just about 400 bips. This coming on the back of easing tensions between US and India. Certainly the setup for the markets look very encouraging and positive.
Hello everyone, this is Vijay Monisha. Let's have some important discussion regarding the market insight with the founder, CEO and CIO of TrustLine Holdings Private Limited, Mr. Arunagiri sir. Welcome sir. How
Thank
are you doing?
Yeah, all well.
Yeah.
Very glad to be part of this podcast.
Thanks, and it's our pleasure too.
Thank you.
So let's start our discussions. So market have seen some important shifts lately, like aggressive GST cuts and sign of reconciliation between the trade talks between India and USA. So how do you see this market setup in the evolving backdrop, sir?
Brilliant. So it's not an easy market. It's a very difficult market for investors of late in the last 12 months. So before I get to the answer, what I can do is I'll step back and look at the broader context for the markets, right? If you go back and look at the last 1 year, this particular government, this administration has taken a lot of measures and steps. So to start with, they came with very steep income tax rate cuts in the budget last year. And then RBI did its part by cutting its repo rate, very steep repo rates. Then now we have GST rate cuts.
Yeah.
So in our view, all these are possible from this administration because on the macro side, the government has managed all the macro metrics, be it fiscal deficit, current account deficits, monetary policy, all these metrics, they have managed it very, very prudently and diligently.
That's true.
And that has given the leeway for the government to go for these level of cuts. In fact, if you look at RBI cuts, it's over 100 bips rate cuts starting February 25. So combined effect of, before we get into, in terms of impacts, one needs to keep this in perspective before we analyze in terms of understanding what is the setup for the markets. So the combined effect of all these cuts, certainly positive for the markets. And, this coming on the back of easing tensions between US and India, certainly the setup for the markets look very encouraging and positive, right? At the same time, one should not lose sight of the fact that the growth, the GDP growth, continue to be constrained. For example, if you look at the nominal GDP growth rate, it's still struggling at around 8.5-9%. So expecting a huge earning acceleration may be very unrealistic. That's what I would say.
And when you look at this tax, interest rate and GST cut, do they really translate into earning growth for companies?
Yeah, it's a very interesting question. At the margin, yes, the combined effect of all these cuts will give a much needed boost for consumption. At the same time, one should not get carried away by the noise. Because at the end of the day, we are talking about a release of about 48,000 crore from these cuts into the economy. How much of an impact it can have on the GDP growth? Even if it has a multiplier impact, even if you assume a reasonable multiplier effect, it's unlikely to have an impact beyond 30-40 bips on the GDP growth. So in terms of earning upgrade, it can be material only if there is going to be a substantial turn in investment demand, which we don't see it happening at this point of time. So as a result, the earning upgrade could be incremental, not very material. So let's assume that the consumption picks up very, very strongly because of these cuts, which in turn leads to a substantial turn in investment demand. In that case, the multiplier impact can be really strong. In such an event, I think the GDP growth can surprise you on the upside. But we don't see it happening this year. Probably next year could be an inflection point for all these, coming together to give a multiplier effect, which can in turn fuel growth. But as we look at it now, yes, the whole cuts sets up the whole thing in a positive direction. But one may need to wait for a year for the real, turn in, for the real material impact on the GDP growth.
When with GST cuts in place and inflation easing a bit, whether RBI does have furthermore headrooms for the interest rates or not, sir?
Yeah, it is. It's a little tricky question. If you look at the RBI, on one side, inflation has cooled off a lot, and you have these GST cuts, which in turn will help cooling further in terms of reducing inflation. And you have dollar weakening on the back of Fed interest rate cuts will support currency. If you look at all this, it should be a very, very easy call for RBI to go for some more rate cuts. But the challenge comes from the trade tensions between US and India. Supposing this doesn't ease off and the tensions continue, that might put pressure on the currency, which is rupee, and which will in turn limit the leeway for RBI to cut rates. But think of it, for us, in our view, more than the interest rate cuts, the liquidity is very important for growth because that's what fuels the credit growth. So RBI will be more conscious about the liquidity, so they'll always be supportive for liquidity. But rate cut, if it happens, of course, it can be a huge signaling effect for the markets.
Finally, let's step back and look at the bigger picture. Over past few months, FII has turned sharply negative, and India has underperformed in both EM peers and developed markets. So, how do you see the market outlook in this context, sir?
Yes, FIs, are selling hugely, and India is underperformed. The underperformance has been very, very stark,
Yeah.
and it is terribly underperformed against both its peers, emerging market peers, as well as developed markets. Let's take, for example, MSCI Emerging Market Index. At the peak in 2024, peak in October, India's weight in MSCI EM index used to hover around 20% plus. And China's weight came all the way down from 30% plus to 24, narrowing the gap to just about 400 bips. That was the case last year. Look at it now. India's weight has come down all the way to 16%. And China's weight has moved up substantially to its old historic levels of 30% plus. So again, widening the gap. This is purely because of the underperformance of Indian markets and outperformance of Chinese indices. Look at the other way. Last 1 year's return, if you compare with all the markets, India is again underperformed significantly. Look at, for example, Hang Seng has done 45% in the last trailing 12 months. Nikkei has done 19%. S&P 500 in US has done 16%. Even Dow Index has done about 10%. Whereas the Sensex and Nifty is done negative or marginally flattish returns. So why is this underperformance? Largely it has been on two factors.
I was about to ask you the same question. Like, what is the main reason for the underperformance of India?
Yeah, largely India is underperformed for two reasons. One, we are trading at a very, very expensive multiple compared to all the other markets. And second reason is our earnings have slowed down, right? These are the two major reasons. On top of it, you have this rising tensions between US and India. That has become a perfect recipe for foreign investors to sell. So globally, investors have turned negative on India. The FIs, pressed heavily on sales, right? For example, in August, they sold close to about $4 billion plus. As we speak in September, even though the trade tensions are giving some signs of revival or easing, in spite of that, FIs continue to sell. So the important question now is, with all these GST cuts, the combined effects of GST plus interest rate and income tax rate cuts, will we see markets breaking out? Will FIs come back? That's a $1 million question. But in our view, the earnings momentum is is absent, and earnings continue to be muted. And if at all, the inflection point could be FI27. Until then, the markets will struggle in a sideways setup. In a way, we call it as a phase of time correction in which markets take a pause until the earnings catches up with valuation. That's the kind of setting we are in. But does it mean the sideways markets are bad for investors? Absolutely no. Sideways markets with a mild positive bias can be really rewarding for stock pickers because it rewards bottom up stock picking. We are in such a setting where bottom up stock picking can get rewarded. So in a way, I think Nifty or markets index is unlikely to break out. At the same time, it could offer a lot of bottom up opportunities. If you're sitting on the right stock, investors can still continue to earn decent returns. To just sum up, there is not going to be fireworks on the index. At the same time, one can expect decent returns if you are very selective, patient, and with a stock specific bottom up approach. That's what I would summarize.
Thank you so much, sir, for spending your valuable time and sharing the valuable market insights. Thank you.
Thank you. Thanks a lot for patient hearing. I hope the viewers will find it very interesting, very insightful. They'll take a lot of value from our discussion. Yeah. Thanks a lot.
Do follow and subscribe TrustLine Holdings Private Limited page on LinkedIn, YouTube, and Twitter for more financial insights.